Welcome to the Explainer. Today we're cracking open the economic engine of Bitcoin. We're not just going to talk about price, we're going deeper. We're going to look at its fundamental rules of money, how new coins are actually born, and the really fascinating economics that get thousands of people to work together to secure the entire network.
All right, so let's just jump right in with the most basic question of all. If there's no government, no central bank printing anything, where does new Bitcoin even come from? Well, the answer isn't physical, it's all in the code. So to get us all on the same page, Bitcoin is this global digital currency, right? It lets you send money directly to someone else, and every single transaction gets recorded on a public ledger called the blockchain. Now, for anyone who's worked with databases, this should sound familiar. Just think of it as a huge shared ledger that you can only add new information to. You can't ever go back and change or delete the old stuff, it's append only. And you know, that append-only rule is absolutely key, because it leads us directly to how new currency gets added to the system in the first place. So yeah, if there's no mint, no printing press, what's the actual mechanism for creating new Bitcoin? How does this network issue new money without anyone being in charge? How does it all happen in a controlled, predictable way?
Well, the answer lies in this really brilliant process called mining, and it's a two-for-one deal. Mining is how new Bitcoins are created, but it's also the very thing that validates all the transactions and keeps the entire network secure and trustworthy.
This whole thing is known as proof of work, and you can basically think of it as a giant global competition. All around the world, miners are using massive amounts of computing power, all racing to be the first one to solve a really complex math problem. The winner of that race gets the right to add the next block of transactions to the ledger, and for all that hard work, they get a reward. A batch of brand new, freshly created Bitcoin.
And this right here, this is the crucial point. This whole automated reward system is Bitcoin's monetary policy. It's not some policy decided in a secret boardroom, nope. It's a set of transparent rules that are literally baked into the code itself. The creation of new coins is predictable, it's transparent, and it's controlled by math, not by a committee.
But this global competition creates a really big problem for the people actually doing the mining. I mean, with so many people competing, how does any one person actually stand a chance of making a living?
Let's really think about that. You've got this global race for one single prize that happens about every 10 minutes. For just one person, what are the actual odds of winning?
Yeah, as you can probably guess, the odds are just astronomically small. For an individual miner, even one with some pretty powerful computers, finding a block all by themselves could literally take years. It's like trying to win a massive global lottery that happens every 10 minutes. That's not a reliable business plan, right?
So what's the solution? It's simple. Teamwork. Miners figured out pretty quickly that if they combine their computing power, what's called their hash power, into these big groups called mining pools, they could dramatically increase their collective chance of winning that reward.
And this really shows you the economic trade-off they're making. Going it alone, solo mining, is a high-variance game. It's like buying a lottery ticket for a massive jackpot that you'll probably never win. Pool mining, on the other hand, is low variance. Sure, you get a much smaller slice of the pie, but you get paid out way more often. It turns a total gamble into a pretty steady, predictable income.
Okay, so teaming up solves the problem of actually winning the reward, but it creates a brand new problem. Once the pool wins, how in the world do you divide up that prize fairly among everyone who helped?
And this is the central challenge for every single mining pool out there. You could have thousands of miners in one pool. Some might have a giant warehouse full of machines, while others are just running a few in their garage. They're all contributing, but how do you split the winnings in a way that's actually fair to everyone's contribution?
As you might guess, there's no one-size-fits-all answer. Instead, pools have developed all these different, kind of sophisticated payment methods. Each one is designed to figure out who did what and pay them accordingly, but they all strike a different balance between risk and predictability for the individual miner.
Okay, so the first and maybe the simplest method is called pay per share, or PPS. You can think of a share as proof that your computer is doing the right work. It's not the final winning answer, but it proves you're contributing. With PPS, the pool operator pays you a fixed, guaranteed rate for every single share you submit. And here's the key part. You get paid whether the pool finds a block that day or not. The person running the pool takes on all the risk. Now, the second big approach is called proportional, or PROP. With this model, the risk is shared by everyone in the pool. You only get paid when the pool actually finds a block. And when it does, the reward is split up proportionally based on how many shares you contributed to that specific successful round.
So here's the bottom line. With PPS, you, the miner, have very little risk. You get a stable, predictable income, almost like a salary. With PROP, you're sharing in the pool's luck, both good and bad. Your income is going to be a lot more variable, but your payout comes directly from the actual bitcoins the pool earns.
But, of course, the innovation didn't stop there. People are always trying to find that perfect balance. So a whole ecosystem of hybrid and modified payment systems has popped up, each one trying to improve on these two basic models.
I mean, just look at how creative these models have gotten. Each one solves a very specific problem. For example, a big flaw with the simple proportional model is something called pool hopping, where miners jump to another pool when they think a block is about to be found. So PPLNS, or paper last end shares, was invented. It bases your payout on your long-term contribution, making it better to stick around. Or look at SMPPS. It's like the guaranteed PPS model, but it adds a cap so the pool operator can't go bankrupt if they hit a really unlucky streak. Each of these is a clever economic tweak designed to balance risk, fairness, and incentives.
So if you take away one thing, it should be this. Bitcoin's economic model is this incredible, self-sustaining system of incentives. It starts at the very top with a monetary policy written in code, and that same logic trickles all the way down to how individual miners decide to work together and share their rewards. Hey, if you found this breakdown valuable, we'd really appreciate it if you'd like, share, and subscribe. It really does help us make more deep dives just like this one.
And we'll leave you with one final thought to chew on. The competition between miners, what's called difficulty, is always increasing. As it gets more expensive and harder to mine, how are these payment models going to have to evolve? And what kind of entirely new economic incentives might pop up to keep the network secure for years and years to come? It's a fascinating question. Thanks for exploring it with us today.